restaurants, my friends. Hogs, in fact, up 45% just this year.
Yeah, I notice it.
Yeah, put that in your bacon pipe and smoke it. The only thing that is down is the VIX, the so-called fear gauge. Joining us now, CNBC contributor and BTIG chief global strategist Dan Greenhouse and CEO of Europe Pacific Capital, Peter Schiff. All right, Dan, I think you follow my logic, right? Is the lack of nervousness a reason to be nervous?
I don't think so. I think it makes her an interesting talking point, but clearly there is...
Well, good, because we're going to talk about it for about 5 minutes.
Cool, that's why we're here. I mean, clearly there is, I don't want to use the word complacency because I'm not really sure what that means in this context, but I think certainly there is a sense entering this year and now in this year that things are better than they have been in some time, and the investment landscape tends to reflect that right now.
Yeah, but you get my point here, Dan. I mean, I understand if bonds are down and those stocks go up, or if gold's tanking year to date. It's still up year to date, even with today's drop, and stocks are up. Money is moving around from one to another. Where is all this new money coming from? The money's going into housing, into bonds, into stocks.
Well, I mean, the economy is always getting larger. The money supply is always going up. The pie is always getting larger. And I mean, by that rationale, if new money never existed, then nothing would go anywhere.
What about you, Peter? I know what you're going to say, but give us something a little bit different. Don't just say it's all due to inflation, surely.
Well, first of all, I disagree that the economy is getting bigger. We have more money, and that's why prices are going up. But the quantity of money is not what determines economic output or growth. It's just a way to price what the economy is going to produce anyway. But we are producing a lot of inflation. You know, when economists used to talk about inflation, what they were referring to was the expansion of the money supply. That's where the word inflate comes from. And the money supply has been growing. We're running big deficits. The Fed monetizes them. Central banks around the world are printing money. We're still doing QE. Interest rates are still at zero. And when you're creating a lot of money, prices rise. Asset prices, stock prices are going up, real estate prices are going up, and consumer prices are going up. And you mentioned earlier that the official statistics are baloney, and they are. And by the way, you know, the price of bologna is going up a lot faster than the stock market.
I want to jump in here for a second for a couple of reasons. The first of which is Peter may be right that the official statistics are not accurate, but people have been complaining about the CPI since it was created. This is not a new concern that certain people feel price increases are different, or decreases differently than other people. This, again, has been around for the better part of 100 years. And with respect to the money supply, the rate of change in the money supply isn't necessarily that rapid right now. I think it's up about 6% and change year over year. Compares to an average of about 7% going back however many decades. The rate of change in the...
But 6% is still a lot of inflation to create. You're destroying 6% of the value of money.
Well,
and one of the other damages that inflation does is inflation stops prices from going down. That's still disruptive to my standard of living. If the government prevents the cost of living from going down, if because of government, food doesn't become less expensive, energy doesn't become less expensive, that's still a problem. Inflation is still doing damage. And, of course, it distorts the markets, it distorts savings and investments, it distorts the allocation of capital, and
Peter,
it retards economic growth.
We're never going to have when the United States is never going to tolerate deflation on an economy-wide scale. It's just not going to happen. So we can sit here and scream.
Unfortunately, yeah, we don't have to tolerate it. You enjoy it. It's the government, it's the debtors that don't want to tolerate money not losing value. They want to borrow money and not pay it back.
Yeah, but for every debtor, there's a credit.
Gentlemen, let's take a breath. I want to bring out something else. Dan, you mentioned the CPI. Actually, I didn't want to say it because it would put an insomniac to sleep, but the PCE price deflator, there I said it. An RBC Capital note caught my eye. They said that in their analysis, 70% of those things mentioned in the PC deflator were up in May. Were up. And yet the government keeps saying there's no inflation. I hope the government's right. My fear, Dan, is that inflation is going to come on quickly, and we're going to get caught out.
Yeah, but what you're leaving out of that, Brian, and I'm sure that statistic is accurate, is if some of those 70 items are Walkman and Nintendo, the first one, then it doesn't matter if they're going up in price because economy-wide they don't have the same impact. And what a CPI or a PCE tries to do is balance out the rich and the poor, the left and the right, the up and the down, to come up with some economy-wide measure of what's going on at any given point in time. There's always going to be people that feel the increase in gasoline more than other people. I don't own a car. Gasoline could go up in however much, and in theory, from a driving standpoint, I'm not going to be affected as much as someone who commutes to work every day.
You don't take a cab, you don't ride in an airplane. I mean, you buy food that's shipped on the highway, so you're still affected by it.
I'm tall and lean. I walk everywhere.
Okay, just real quick, Peter. In your scenario, is the Fed? When is the Fed going to raise rates? To what degree do you feel they're already behind the curve?
Look, they're not going to raise rates until there's a currency crisis, until there's a bond crisis. They're going to keep rates at zero to postpone the pain as long as they can. But even if you look at the most recent CPI numbers for April, year over year, it's 2%. CPI up 2%, PPI up 2.1. So we're already at this theoretical 2% target, and the Fed is complaining that we don't have enough.
Now, hold on a second.
It's going to get a lot higher.
That's not right.
And
That's
it's
not
going to disproportionately hit the vast majority of people.
Peter,
Guys,
you're
would
wrong.
love to continue this party another time on that
I'm
note.
wrong. Those were the government numbers.
But that's not the.
And
You're not
they're
supposed.
low.
That's not how.
Okay, Dan, keep on going. Bottom line.
The bottom line is the Federal Reserve is not shooting for 2% today, tomorrow, or the next day. It's a theoretical price increase that you want over the medium term. And the first time you hit 2% coming from the bottom, so to speak, is not the time to tighten. Just ask the Japanese how that works out.
All right, guys, we're gonna leave it.
What if we get to 3? What if we get to 4? Nixon imposed wage and price controls. When we got to 4,
there's something
we're halfway
in between a moderate level of inflation and jumping out of a building. There's something in between.
We hate to break up the party, but we're
there's
going
not
to
a
anyway.
big jump between 2% and 4%.
Listen, clearly,
you can do that in a matter of months.
We know you don't own a car, but you know that the feed for your horse and your omnibus clearly is going up in price. Okay, so let's leave it there. Guys, thank you very much. And a correction on my part. Once again, I confused the Scottish with the Canadians. It's easy to do.
It's
RBS, not RBC.